I've got 4 investing strategies to take advantage of any stock market. In this video, we'll look at the history of bull and bear markets as well as what caused stocks to crash over the last 50 years. I'll then reveal 2 investing strategies that you can use for each type of market. We're talking bull markets versus bear markets today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's Talk Money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Every time the stock market starts wobbling like it has lately, the news just fills up with talk about bull markets and bear markets. Now it is important to know the difference between a bull versus a bear market, and I've got some great strategies for investing in each. But the truth is that sometimes all of this news just leads to people making the worst investing decisions possible. Investors see those headlines about a bear market right around the corner and they just rush out to panic sell. Or some hack on TV screams bull market and investors rush out to buy a certain stock. It's why the average investor earns just 2.6% annually over the decade through 2013, according to this research by Dalbar. And that's versus an average return of over 7% on stocks. It's those knee-jerk investing decisions, and that's what I want to save you from in this video. We'll cover a quick definition of bull market and bear, and then we'll look at the history of each in the stock market. We'll look at the average returns and losses in each market type, how long they last, and what's caused the bear markets in the past. I'm then going to show you 4 investing strategies you can use to maximize your returns in each market. You'll be able to use these strategies to not only protect your money in that bear market, but to boost your returns in either. So the technical definitions of these 2 types of markets aren't very good. A bull market is just when stock prices are increasing over more than a few months. A bear market, on the other hand, is any drop of 20% or more from the most recent high in a stock or the market as a whole. So you can have a bull or a bear market in the overall stock market or just an individual stock or investment. But what's more important here is the investor sentiment in each of these. Investors' sense of excitement in a bull market and then that sense of panic in a bear. Now that's really what drives prices in this market and what's going to signal those investing strategies that we'll talk about later. So let's look first at this data by McKinsey Investments on the composite S&P and TSX index. So this is going to be data on US and Canadian stock markets. We'll look at some bear markets going back to the 1930s, but I like to use this broader data back only to 1956 for a more modern perspective on the markets. There have been 12 bull markets since 1956, though there's some argument here whether that 2001 gain was really a bull market or just a quick bounce in the 2000 crash. On average, stocks have jumped 129% from the low of that previous bear market and have rallied for 54 months. Now on that last point, it does seem like the bull markets are lasting longer than they have in the past. 5 of the last 7 bull markets have all been over that 54-month average, so these numbers could be skewed a little bit low by the older data. There have also been 12 bear markets of a 20% drop or more since 1956, with stocks falling an average of 28%, and for that plunge in prices lasting an average of 9 months from the previous highs. Now it's said that history doesn't repeat itself, but it does tend to rhyme. That means that while no 2 bear market causes are going to be the same, there are some common themes that cause stocks to plunge. So looking at some of these causes for bear markets in the past, we can get a sense for warning signs of a future stock market crash. And we don't even need to go too far back. Just looking at the causes of stock crashes over the last 60 years gives us a really good idea of those common causes. So starting with the crash of '56, we saw the economy booming in those post-war years. And this is really where we hear the saying that the Federal Reserve stops the party by taking away the punch bowl. Fed Chair Martin previewed higher rates in a 1955 speech, and fears over a recession were aggravated by the Suez Canal crisis and the Soviets' invasion of Hungary. So this one was the Federal Reserve increasing the cost of borrowing and then geopolitical risks threatening to push the world into war. The stock crashes in '61 and '66 don't even register on some bear market charts because they were just so quick and so low. The 1961 crash was the original flash crash, with stocks falling 6% on a single day and really for no reason at all. Interest rates were rising for most of the decade, but nothing really set off these 2 mini crashes. Now, it wasn't until 1969 that the US saw another major crash, and this is probably one of the most understudied bear markets out there. The late 60s were one of the most chaotic times in US history, with an escalation in Vietnam, racial tensions, and the assassinations of Robert Kennedy and Martin Luther King Jr. Now the recession here wasn't so bad, it wasn't so deep, but it was followed a huge run up in stock prices. So all that political uncertainty, rising inflation, and then interest rates, It all came together, came to a head for a 36% drop in the S&P 500 from late 68 through May 1970. Now, runaway inflation started the bear market of 73 when Nixon announced relaxing price controls. Consumer prices jumped 21% in just 2 years here. So not only did real consumer spending fall off a cliff, but you had those twin fears of recession and interest rates. Now, a lot of pundits want to blame the 81 crash on the Federal Reserve, and it's true that Chair Volcker raised rates as high as 20% just to offset those double-digit inflation that year. But this is also one of the first stock market crashes in modern history that was really about high stock prices. Shares had surged 288% just in the 7 years and had just gotten way ahead of valuations. The stock market crash of October 1987 is probably the most famous, with a one-day loss of 23% on the Dow Jones. It was actually pretty brief though, with the bear market only lasting 3 months, and this one was blamed on the surge in computerized trading that just went haywire when stock prices started to plunge. Iraq's invasion of Kuwait is considered the match that lit this 1990 recession, though this was really a borderline crash. Oil prices were more than doubled during the war, so people were worried about that inflation and consumer spending. Now, the currency crisis in the late 90s was also more of a hiccup in that dot-com bubble, and even with that 27% drop mid-year, stocks still finished 98 with almost a 30% gain. So here it wasn't until the Fed started raising interest rates in 99 that the market took its cues and prices plunged 49% starting in March 2000. Now, besides the fear of those higher interest rates that could cause a recession, this one was really about valuations also. Tech stocks were trading on pure adrenaline and had jumped almost 900% through the last decade. Finally, before we get to those bull and bear market strategies, most investors are going to remember the big crash of 2008. After cutting rates to just 1% in 2003, the housing market exploded and the loan market started creating signs of a bubble. The Federal Reserve raised rates 17 times through June 2006 just to cool down this pace. Now, the problem here was that not only did higher rates slow down the economy, they also uncovered a huge problem in the mortgage market. So what we had is people were getting loans with no docs and no jobs, and then with rates resetting after a few years. When these loan rates jumped and it became clear that borrowers could in no way make these payments, the bubble just burst and led to the worst crash since the Depression. So looking at these past bear markets, we see some common causes that we can use to signal a stock market crash or just a recession. Now, one of the most frequent causes that we've seen, or at least parallel changes, is the Fed raising those interest rates. Now, I don't want to put the blame solely on the Fed here, though. They are public servants just trying to manage full employment, so strong economy, but at the same time price stability, so lower inflation. That means raising rates when the economy overheats and decreasing rates to jumpstart it when the economy slows down. But the fact is that increasing interest rates do slow down the economy and can lead to a recession. If this is on the back of booming stock prices, then a lot of times investors are just going to use that as an excuse to take profits and stocks start falling in the sell-off. Now, these other two causes, high inflation and a recession, are related. The Fed is more likely to raise rates when consumer prices jump, and all this means lower consumer spending and an economic slowdown. Now, these last two bear market signals, booming stock prices and those external stocks, aren't usually causes in themselves, but just the straw that really breaks that camel's back. When you've already got fears of a slowdown or really expensive stock prices, any headline risk or the potential for war can send the market lower fast. So now let's look at those two investing strategies for each of these types of stock markets. Two strategies for a bull market and two for the bear. First though, as a kind of informal survey, where do you think we are right now in this bull versus bear market cycle? When do you think the next bear market crash is going to hit stocks and why? So scroll down and let us know in the comments below this video. Where do you think we are in the cycle? When's the next bear market coming? So this first strategy here for investing in a bull market is going to be focusing on those sectors of the economy that do the best when the economy is growing. Here we see research by Fidelity on the 11 stock sectors and the average annual return at the first hint of a bull market. So in those early stages of a rebound. Financials and consumer discretionary stocks both do really well because these are two of the hardest sectors hit during a bear market. Lending rebounds and people start spending again on all those beautiful things that we love but really don't need to buy. Now the black diamonds here, and these are really important. These show how often the sectors have produced that positive return during these early stages of a bull market. For example, you see that consumer discretionary has jumped in every single instance, and shares of industrial companies aren't that far behind with a 90% hit rate. Now before you rush out to sell your stocks, this doesn't mean that you're jumping in and out of stocks or timing the market. It just means maybe you focus a little bit more of your money on these cyclical sectors during a bull market. You don't want to rush out to sell your shares in these non-cyclical sectors like utilities, but maybe you just put any of your new money deposited in these new sectors that benefit from a bull market. Now, the next strategy for investing in a bull market is called growth investing. This means looking for stocks or companies growing sales and earnings at a faster rate than the market as a whole. So growth stocks are those companies with profits that are growing faster than competitors in their sector or industry. And that last part is really important. I want you to hear that again. If you're just screening for stocks with fast sales or earnings growth, you're just going to get a list of stocks exclusively in a few sectors like technology and biotech. Growth is just naturally going to be faster in these innovative sectors versus what you'll find in consumer staples or industrials. So when you're looking for growth stocks to buy in that bull market, you want to do a separate screen for each sector. You want to find a couple of growth picks in each sector or even each industry to give yourself that diversified portfolio that doesn't depend on any one part of the economy. Now, investing in a bear market is going to be the opposite of this in many ways. Here we see that same analysis by Fidelity of the sector performance during a recession. Now, the sectors that do best here are those consumer staples, utilities, and healthcare, all with hit rates above 70% during a recession. So again, when you see some of these recession or the bear market signals like rising interest rates or inflation, maybe just start shifting your new investments into these non-cyclical sectors. That's sectors of the economy that benefit from stable sales and even during a recession, things that people need to buy no matter what. Here I've shown buy, sell, and hold signals for the sectors depending on how well they tend to do in different stages of the economy. These early and mid stages would be bull markets, and then the late stage would be kind of a transition point into that bear market. Again though, you don't necessarily need to sell out of a sector when it says sell here. I just wouldn't be adding new investments into the stocks within that sector. The other bear market strategy you can use is kind of the opposite of growth investing, and that's called value investing. Now, value investing is focusing on those fundamental value of a stock and its share price. Here you're prioritizing stocks that trade below their fair value on an earnings or on a sales basis. Now, those of you in the Bowtie Nation know I'm not a big fan of that price to earnings ratio because it's just so easy for management to manipulate reported earnings. Instead, though, focus on other price multiples like the price to sales measure when you're picking these cheap stocks. Just like that growth investing strategy, here you want to use that idea of investing in each sector as well. If you were just to filter for stocks with the lowest PE ratios or price to sales ratios, you'd get a list of mostly companies in the utilities and telecom sectors. Instead, filter your search by each sector individually to find the best value stocks in each group. Now click on the video to the right to see how I pick stocks for long-term investing. I'll show you how to find universal trends and those forever stocks that are going to benefit in bull and bear markets. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.